Welcome back to Accountant's Desk. In this video, we will learn how to record journal entries using simple and practical examples, perfect for beginners. If you haven't watched our video on golden rules of accounting, make sure you check it out. The link is in the description below. And if you are a small business owner looking for accurate and reliable bookkeeping support, just fill the Google form in the description. We will reach out to you. Journal entries in accounting. What is a journal in accounting? A journal is a book of original entry where transactions are recorded in the chronological order as and when they take place. This means a journal entry is the first record of a transaction in accounting. It captures the date, amount, accounts involved, and whether they are debited or credited. Think of a journal as a diary for your business. Every time money comes in or goes out, you write it down with full details. Let's see the journal entry format. Date, particulars, ledger, folio, debit and credit. You record the date of the transaction and the accounts debited and the account credited, and then the narration. Let's now use the simple example and understand. Example, journalize the following transactions in the books of Mr. Ram. April 1st, business commenced with a capital of rupees 10 lakh. April 3rd, deposited in the bank account rupees 5 lakh. April 5th, purchased plant and machinery costing rupees 2,30,000 by paying 30,000 cash. April 7th, purchased goods worth rupees 40,000 for cash. April 9th, paid a check of rupees 2 lakh to the supplier for plant and machinery. You can see that on April 5th, we purchased plant and machinery costing rupees 2,30,000 and we paid only 30,000 in cash. And the remaining 2 lakh is paid on April 9th. April 11, sold goods for 70,000 rupees. April 15, withdrawn by the proprietor rupees 35,000 cash for personal use. It is a drawing. April 20th, insurance paid by check 2,500. April 22, salary paid 5,500. April 30, furniture of rupees 30,000 purchased in cash. We'll start with the first transaction. That is, business commenced with a capital of rupees 10 lakh. That means the owner is investing into the business. So cash comes in and capital is credited. Here the two accounts are cash account and capital account. Cash is real account, cash comes in the business. So debit what comes in. And the other account is capital account. Capital account is personal account and the proprietor is giver. So credit the giver. So we record it as, this is the format. Journal entries in the books of Mr. Rao. Date, particulars, ledger, folio, debit and credit. And we record it as on 1st April, cash account debit 10 lakh rupees to capital account 10 lakh rupees. And the narration is being capital introduced into the business. Next transaction is April 3rd, deposited in a bank account 5 lakh rupees. Now cash decreases and bank balance increases. So the two accounts are bank account and cash account. Bank account is personal account. Bank receives the cash, so debit the receiver. And cash account, cash is real account. Cash goes out, so credit what goes out. So we record it as April 3rd, bank account debit 5 lakh rupees to cash account 5 lakh rupees, being cash deposited into bank. And the next transaction is April 5th, purchase plant and machinery costing rupees 2,30,000 by paying 30,000 in cash. In this transaction, 30,000 is paid now and the rest 2 lakh will be paid later. So we debit the full value of the asset and credit cash for what is paid and credit a payable for the balance. So here 3 accounts are involved. That is, the accounts are plant and machinery account, cash account and machinery supplier account. So plant and machinery, it is real account. Asset comes in the business, so debit what comes in. And cash account, it is real account. Cash goes out. So credit what goes out. And supplier is a personal account. And supplier is creditor. So credit the giver. So the transaction is April 5th, plant and machinery, debit account, 2,30,000. It is the whole amount. And next we paid cash. To cash, only 30,000. And the rest will be paying on credit basis to machinery supplier account, that is 2 lakh. And the narration is being machinery purchased partly in cash and partly on credit. That is 2 lakh we have to pay to the supplier. And the next transaction is purchased goods worth rupees 40,000 for cash. Here the two accounts are purchase account and cash account. Purchase account is a nominal account, expenses incurred, so debit all expenses. And cash account, cash is real account, cash goes out. Credit what goes out. So we record it as April 7, purchase account debit 40,000 to cash account 40,000, being goods purchased for cash. And the next transaction is April 9, paid a check of rupees 2 lakh to the supplier for plant and machinery. This is the same transaction from 5th April. That is, now we are paying 2 lakh rupees. And here the two accounts are supplier's account and bank account. Supplier's account, supplier is a personal account and liability reduces. So debit the receiver. And bank account, bank is a personal account. Bank balance goes down. So credit the giver. So we record it as April 9, machinery supplier account debit 2 lakh rupees to bank account 2 lakh rupees, being payment made to supplier by check. And the next transaction is April 11, sold goods for rupees 70,000. Here the two accounts are cash account and sales account. Cash is a real account and cash comes in the business. So debit what comes in. And sales is a nominal account and it is income earned. So credit all incomes. So we record it as April 11, cash account debit 70,000 to sales account 70,000, being goods sold for cash. And the next transaction is April 15, withdrawn by the proprietor rupees 35,000 cash for personal use. Here the two accounts are drawings account and cash account. Drawings account, it is a personal account and owner is the receiver. So debit the receiver. And cash account, cash is real account, cash goes out of the business. So credit what goes out. So we record it as April 15, drawings account debit 35,000 to cash account 35,000, being cash withdrawn by proprietor. And the next transaction is April 20, insurance paid by check 2,500. Here the two accounts are insurance account and bank account. Bank account because it is paid by check. So insurance account, it is nominal account and it is expenses for the business. So debit all expenses. And we paid by check, so bank account. Bank is a personal account, bank balance reduces. So credit the giver. So we record it as April 20th, insurance account debit 2,500 to bank account 2,500, being insurance premium paid by check. And the next transaction is April 22, paid salary 5,500. Here the two accounts are salary account and cash account. Salary account, it is nominal account and it is expenses to the business. So debit all expenses. And cash account, cash is a real account, cash goes out of the business. So credit what goes out. So we record it as April 22, salary account debit 5,500 to cash account 5,500, being paid salary. April 30th, furniture of rupees 30,000 purchased in cash. Here the two accounts are furniture account and cash account. Furniture account is real account and furniture is an asset and it comes in the business. So debit what comes in. And cash account. Cash is a real account. Cash goes out of the business. So credit what goes out. So we record it as April 30th, furniture account debit 30,000 to cash account 30,000, being furniture purchased for cash. As you saw, every entry follows a logic. What comes in is equals to debit, what goes out or is owned is credited. So that's it for today's video. Now you know how to record the transactions in journal. If you found this video helpful, give it a like, share and subscribe to Accountant's Desk for more clear and practical accounting content. Check out the description for the golden rules of accounting. And if you are a small business owner looking for reliable bookkeeping services, fill out the Google form and we will reach out to you. Thanks for watching and we will see you in the next video. Hi everyone, welcome back to Accountant's Desk. In today's video, we will understand journal entries with complete account type analysis, rules of debit and credit, and real life examples. By the end of this video, you will understand the why behind every debit and credit. So, before we start learning journal entries, let's understand what exactly a journal is. So, what is a journal in accounting? A journal is a book of original entry where transactions are recorded in the chronological order as and when they take place. A journal is basically the first book of accounting where every business transaction is recorded as soon as it happens, in the order it happens. We call it the book of original entry because all transactions are recorded here first and only then they move to the ledger. Every transaction affects at least two accounts. To decide which account to debit and which account to credit, we classify accounts into three types. Golden rules of accounting. Account type, rule and example. Personal account, the rule is debit the receiver and credit the giver, and it includes debtors, creditors, capital, drawings related to person. Real account, the rule is debit what comes in and credit what goes out. And the examples are cash, bank, furniture, machinery, land related to assets. And nominal account, debit all expenses and losses, credit all incomes and gains. And the examples are rent, salary, sales, purchases, interest. It relates to expenses and incomes. These three golden rules are the key to every journal entry. Now let's apply these rules to the journal entries one by one. Let's start with the examples. Started business with cash rupees 1 lakh. Here the two accounts affected are cash account and capital account. Cash account, cash is real account and debit what comes in. Capital account, capital is personal account and personal account credit the giver because the owner gives cash in the form of capital. So the journal entry is cash account debit 1 lakh to capital account 1 lakh rupees. And the narration is being capital introduced in business. Here the owner gives capital and the business receives cash. So cash is debited and the business owes it to the owner. So capital is credited. Next, purchase goods for cash rupees 20,000. Here the two accounts are purchase account and cash account. Purchase account. Purchase account is a nominal account and nominal account the rule is debit all expenses and cash account. Cash is real account and for real account credit what goes out. So the journal entry is purchase account debit 20,000 to cash account 20,000 rupees. And the narration is being goods purchased for cash. Purchases are the expenses for the business, so we debit it. Purchased goods on credit from Ram, rupees 15,000. Here the two accounts affected are purchase account and Ram account. Purchase account. Purchase account is a nominal account and for nominal account the rule is debit all expenses. And Ram account. Ram account is a personal account and for personal account credit the giver. So the journal entry is purchase account debit 15,000 to Ram account 15,000 and the narration is being goods purchased on credit. Since Ram supplied goods without cash, so he becomes our creditor. In the previous transaction, we recorded purchase account to cash account because it was cash transaction. But here it is not mentioned that we have paid money to our creditor, Ram. So we have taken it as Ram because we owe him money. Next. Sold goods for cash rupees 30,000. Here the two accounts affected are cash account and sales account. Cash account is real account and for real account debit what comes in. And sales account is nominal account and the rule for nominal account is credit all incomes. And the journal entry is cash account debit 30,000 to sales account 30,000 rupees and the narration is being goods sold for cash. Sales generate income and all incomes are credited. Next, Sold goods on credit to Mohan, rupees 25,000. Here the two accounts affected are Mohan account and sales account. Mohan account, it is personal account and the rule for personal account is debit the receiver. In sales account is nominal account and the rule for nominal account is credit all incomes. So the journal entry is Mohan account debit 25,000 to sales account 25,000 rupees. And the narration is being goods sold on credit. Now Mohan becomes our debtor because he owes money to us. We have sold him goods, but he has not yet paid us the money. So he owes us money. So it is credit transaction. If he would have paid us the money, we would have taken cash account debit to sales account. But since he has not yet paid us the money, we have taken Mohan account. In future, he will pay us. Next, paid cash to creditor Ram 10,000 rupees. Here the two accounts affected are Ram account and cash account. Ram account, it is personal account and the rule for personal account is debit the receiver. And cash account, cash is a real account and the rule for real account is credit what goes out. So the journal entry is Ram account debit 10,000 rupees to cash account rupees 10,000 and the narration is being payment made to Ram. We debit Ram because he is the receiver of the cash. Purchase furniture for cash rupees 50,000. Here the two accounts are furniture account and cash account. Furniture account, it is real account because it is an asset and furniture comes in the business. So the rule for a real account is debit what comes in because furniture is coming in the business. And cash account, cash is also a real account and cash goes out of the business. So the rule for what goes out is credit what goes out. So the journal entry is furniture account debit 50,000 to cash account 50,000 rupees and the narration is being furniture purchased. Furniture is an asset, not expenses. So the real account rule is applied. Next, purchase machinery on credit from Ram Limited 2 lakh rupees. Here the two accounts are machinery account and Ram Limited account. Machinery account, it is real account because it is an asset and the rule for real account is debit what comes in because machinery is coming into the business. And Ram Limited account, Ram, it is personal account and Ram is the giver. So credit the giver. And the journal entry is machinery account debit 2 lakh rupees to Ram Limited account 2 lakh rupees. And the narration is being machinery purchased on credit. It is mentioned that we have purchased machinery on credit. But if it was given purchased machinery for rupees 2 lakh rupees, we would have considered it cash transaction. And instead of Mr. Ram Limited, we would have taken it to cash account because cash goes out of the business. Because cash is real account and the rule for real account is credit what goes out. So we would have taken it machinery account debit 2 lakh rupees to cash account 2 lakh rupees. But since it is credit transaction, we have taken machinery account debit 2 lakh rupees to Ram Limited account. Okay, next. Paid salary in cash rupees 8,000 rupees. Here the two accounts affected are salary account and cash account. Salary account, it is nominal account and salary is expenses to the business. So the rule for nominal account is debit all expenses. Cash account is real account and cash goes out of the business. So credit what goes out. And the journal entry is salary account debit 8,000 rupees to cash account 8,000 rupees and the narration is being salary paid. Next, paid rent 5,000 rupees. Here the two accounts affected are rent account and cash account. Rent account, it is nominal account and rent is expenses for the business. So the rule for nominal account is debit all expenses. And cash account is real account and cash goes out of the business. So credit what goes out. And the journal entry is rent account debit 5,000 rupees to cash account rupees 5,000 and the narration is being rent paid. Next, Cash deposited into bank 20,000 rupees. Here the two accounts affected are bank account and cash account. Bank account is real account, and the rule for real account is debit what comes in. And cash account is also real account, and the rule is credit what goes out. Here the cash from the business goes to the bank. So cash goes out, and for bank it is what comes in, debit. And the journal entry is bank account debit 20,000 rupees to cash account 20,000 rupees. And the narration is being cash deposited. Next, cash withdrawn from bank 10,000 rupees. Here the two accounts affected are cash account and bank account. Cash account, it is real account. And for real account, the rule is debit what comes in because cash comes in the business. And bank account is also real account. And from bank, cash goes out. So credit what goes out. And the journal entry is cash account debit 10,000 rupees to bank account 10,000 rupees. And the narration is being cash withdrawn. Next, check issued to Ramesh 8,000 rupees. Here the two accounts affected are Ramesh account and bank account. Ramesh account is personal account and Ramesh receives check, so debit the receiver. And bank account is real account and check goes out from bank, so credit what goes out. Journal entry, Ramesh account debit 8,000 to bank account 8,000 rupees, and the narration is being check issued. Next, owner withdrew cash 6,000. Here the two accounts affected are drawings account and cash account. Drawings account, it is personal account and owner receives the cash, so it is debit the receiver. And cash account, cash is real account and cash goes out of the business, so credit what goes out. And the journal entries, drawings account debit 6,000 rupees to cash account 6,000 rupees, and the narration is being cash withdrawn. Goods returned to Mr. Ram 2,000 rupees. Here we have purchased goods from the supplier and now we are returning it to supplier. So the two accounts affected are Mr. Ram account because he is the receiver, and the other account is purchase return because we are returning the goods. Mr. Ram account is a personal account because he is the receiver and debit the receiver. And next, purchase return account because we are returning the goods, and purchase return, it is nominal account. So it is income. When we return the goods, we receive the cash. So it is income to the business. And the rule for nominal account is credit all incomes. And the journal entry is Ram account debit 2,000 rupees to purchase return account 2,000 rupees. And the narration is being goods returned. Goods returned by Mr. Mohan 3,000 rupees. Now it is sales return because returned by Mr. Mohan to the business means we are receiving the goods that we have sold to Mr. Mohan, means it is sales return. Here the two accounts affected are sales return account and Mohan account. Sales return account, it is nominal account and it is expenses. If we sell the goods and if the customer returns it, then it is loss for the business or expenses. So debit all expenses and losses. And the other account is Mohan account. Mohan account is personal account and the customer returned the goods. So he is the giver. So credit the giver. And the journal entry is sales return account debit 3,000 rupees to Mohan account 3,000 rupees. And the narration is being goods returned. Now how to understand if it is returned by customer or we have returned to the supplier. If the goods is returned by means the customer has returned to us. If we have returned to means we have given to the supplier. Just returned by or returned to. If it is returned by, then it is returned by customer. And if it is returned to, then we have returned to the supplier. Next, Discount allowed to Mohan 500 rupees. Now we have allowed discount to Mohan. Okay, and the two accounts affected here are discount allowed and Mohan account. Discount allowed, it is nominal account. It is expense for the business. So debit all expenses. And the other account is Mohan account. Mohan account is personal account. And credit the giver means he gives us the money apart from discount. And the journal entry is discount allowed, debit 500 rupees to Mohan account 500 rupees. And the journal entry is being discount allowed to Mohan. Next, discount received from Ram 400 rupees. Here the two accounts affected are Ram account and discount received. Ram account, it is personal account and Ram is the receiver of the amount after deducting the discount. So debit the receiver and discount received. Discount, it is an income because we are paying less and it is nominal account. Discount received, it is nominal account, and since we are paying less, it is income to the business. So credit all incomes and gains. And the journal entry is Ram account debit 400 rupees to discount received account 400 rupees, and the narration is being discount received. Paid electricity bill 1500 by check. Here the two accounts affected are electricity expense account and bank account because it is paid by check. If it is cash, then we would have taken cash. Electricity expenses, it is nominal account, and for nominal account the rule is debit all expenses. And bank account is real account, and the rule is credit what goes out. If it was not mentioned check, we would have taken cash. Now in this transaction, it is mentioned it is paid by check, so we have taken bank. And the journal entry is electricity expense account debit 1500 to bank account 1500 rupees, and the narration is being bill paid. Next, paid insurance 3000 rupees cash. Now here it is mentioned we have paid in cash. So the two accounts affected are insurance account and cash account. Insurance account, it is nominal account and insurance is an expense, so debit all expenses. And cash account is real account and cash goes out of the business, so the rule for real account is credit what goes out. And the journal entry is insurance account debit 3000 rupees to cash account 3000 rupees, and the narration is being insurance premium paid. Next, received commission 2000 cash. Here it is mentioned cash, so it is cash transaction, and the two accounts affected are cash account and commission account. Cash account, it is real account, and received commission, it is cash comes in the business, so debit what comes in. And commission received, commission is nominal account, commission is income to the business because it is received, so the rule is credit all incomes. And the journal entry is cash account debit 2000 to commission received account 2000 rupees, and the narration is being commission received. Next, paid telephone charges 800 rupees cash. Here the two accounts affected are telephone charges and cash. Telephone charge, it is an expense, so it is nominal account, and the rule for nominal account is debit all expenses. Cash account is real account and cash goes out because telephone charges are paid, so credit what goes out. And the journal entry is telephone charges account debit 800 to cash account 800 rupees, and the narration is being bill paid. Received interest on investment 1000 rupees. Here the two accounts affected are bank account and interest received account. Bank account, it is real account and interest is received, so it is debit what comes in. And interest received account, it is income, interest is income, so nominal account, and the rule is credit all incomes. And the journal entry is bank account debit 1000 rupees to interest received account 1000 rupees, and the narration is being interest received. Next, purchase goods from Mr. Sharma of 50,000 and paid 20,000 cash. Now here we have purchased the goods And we have paid also, but not fully. So it is partial payment. Here, three accounts are affected, that is purchase account, cash account, and Mr. Sharma's account. Why? Because purchased goods of 50,000. So it is purchase account. And we paid cash 20,000. So cash account is also included. But we have purchased 50,000 goods and paid only 20,000. Remaining 30,000 we have to pay Mr. Sharma. So Mr. Sharma's account also is included. So the three accounts are purchase account, cash account, and Mr. Sharma's account. Let's see. Purchase account, it is nominal account, and purchase, it is expenses. So debit all expenses. And next, cash account. Cash account is real account, and cash goes out of the business because we paid when we purchased. So credit what goes out. And next is Sharma account. Mr. Sharma, he is person, so it is personal account, and he is the giver of goods. So credit the giver. And the journal entry is purchase account 50,000 rupees because we have purchased the goods of 50,000 rupees. Then to cash account. We have paid cash immediately 20,000 rupees. And the remaining amount is 30,000 rupees we should pay to Sharma. So the next account is to Sharma account 30,000 rupees. And the narration is being purchased goods partly cash and partly credit. Next. Sold goods to Ravi 40,000 rupees and received 15,000 cash. Now here we have sold goods worth rupees 40,000 and we have received 15,000 cash. Remaining 25,000 Ravi has to pay us. So here three accounts are affected, that is sales account, Ravi account, and cash account. Cash account, it is real account and cash comes in the business, so it is debited. And Ravi account, Ravi is personal, he is receiving the goods, so debit the receiver. And sales account, it is nominal account, and sales, it is income. After selling the goods we receive money, so it is income, so credit all incomes. And the journal entry is cash account debit 15,000 rupees because Ravi has paid us 15,000 rupees. Then Ravi account, that is 25,000 rupees because out of 40,000 rupees he has paid us only 15,000 rupees. So 40,000 minus 15,000 is 25,000 rupees he will pay us in the future. And total sales is two sales 40,000 rupees because that is the total sales. And the narration is being goods sold partly cash partly credit. Paid wages 4,000 rupees. Here the two accounts affected are wages account and cash account. Wages account, it is nominal account because it is expenses, and the rule for expenses is debit all expenses. Cash account is real account and cash goes out of the business, so credit what goes out. And the journal entry is wages account debit 4,000 to cash account 4,000 rupees, and the narration is being wages paid. Next, purchase stationery 500 rupees. Here the two accounts affected are stationery account and cash account because we paid cash. Stationery account, it is nominal account because it is expenses, and the rule for nominal account is debit all expenses. And cash account is real account. Cash goes out of the business, so credit what goes out. And the journal entry is stationery account debit 500 rupees to cash account 500 rupees, and the narration is being stationery purchased. Next, received rent 7,000 rupees. Here the two accounts affected are cash account because we have received 7,000 cash, and rent received account. Cash account is real account and cash comes in the business because rent received, so debit what comes in. And rent received, it is nominal account, and since it is income, it is credit all incomes. And the journal entries, cash account 7,000 rupees to rent received account 7,000 rupees. And the narration is being rent received. Now you can see in all the transactions, first we have decided which are the two accounts affected for the transaction. Okay, cash account or rent received account. Then we have decided whether it is personal account, real account, or nominal account. And based on that, if cash comes in the business, then accordingly we have decided if it is debit or credit. So once you understand account type, journal entries are no longer about memorization, they are logical. Before we wrap up, let's look at some of the common mistakes students make while passing journal entries and how to avoid them. These small errors can completely change the meaning of a transaction. First, confusing personal and nominal accounts. Students often confuse whether to treat something as personal or nominal. For example, rent account is nominal because it is an expense. Rent received account, it is nominal because it is income. Ram account or Suresh account are personal account because they are the name of the people. So always ask yourself, is it a person or asset or an expense or income? It helps you to pick the right rule. Forgetting dual aspect. Every transaction has two sides. Many students write only one account in the entry. Remember, every transaction affects two or more accounts. If something comes in, something must go out. For example, if you purchase goods for cash, goods come in, that is debit, and cash goes out, that is credit. So never record one sided entries. Mixing up real and nominal accounts. When purchasing assets like furniture or machinery, students wrongly debit purchase account. Purchases relate only to goods meant for resale. So, when you buy furniture, it is an asset, not an expense. Hence, use furniture account as real account, not purchase account. Ignoring narration. A journal entry without narration is incomplete. The narration explains the purpose. For example, being salary paid in cash. It's a simple line but very important for clarity and professionalism. Recording personal transactions in business books. Remember, accounting follows the business entity concept. If the owner withdraws cash for personal use, we use drawings account. We never call it personal expense directly. Keep business and personal accounts strictly separate. Writing wrong account names. Writing cash account instead of bank account when payment is made by check. Always identify the mode of transaction. If cash is paid, then it is cash account. If check or bank transfer, then it is bank account. Forgetting to write debit and to properly. In journal format, debit must appear after the debit account name and to before the credit account name. Example, salary account debit to cash account. This standard format improves readability. Using capital or drawings incorrectly. Capital, money or goods introduced by the owner, that is, business receives. Drawings, money or goods taken away by the owner, that is, business gives. They are exact opposite, so be careful. Forgetting to classify compound entries. When one transaction affects more than two accounts, like purchased goods rupees 50,000 and paid 20,000 cash and balance on credit. Students sometimes write two separate entries. That's wrong. It's a compound journal entry and all accounts should appear together in one entry. Not understanding the effect on business. Accounting is not just about rules, it's logic. Before writing any entry, ask yourself what came into the business, what went out, is it expense or income? This thinking approach ensures your debit and credit always make sense. So, these are the top 10 common mistakes students make in journal entries. Remember, accuracy in basics is what builds confidence in advanced topics like ledger, trial balance, and final accounts. If you found this video helpful, don't forget to like, share, and subscribe to Accountant's Desk for more accounting concepts. Welcome back to Accountant's Desk. In part 1, we covered the basics, the meaning, format, and the golden rules of debit and credit, along with one simple example. In this video, we will take it a step further. We will solve a complete practical question, recording each entry step by step, and I'll explain the logic behind every debit and credit so you truly understand how journal entries work in real life. And if you are a small business owner in need of bookkeeping services, just fill out the Google form linked in the description and we will reach out to you. Alright, let's get started. Mr. Ram furnishes the following information. Transactions during the month of April 2025 are as under. 2025, April 1st, started business with cash rupees 1,50,000. 1st April, purchased goods from Manisha rupees 36,000. 1st April, purchased stationery for cash rupees 2,200. 2nd April, opened a bank account with SBI for 35,000 rupees. 2nd April, sold goods to Priya for 16,000 rupees. 3rd April, received a check of 16,000 rupees from Priya. 5th April, sold goods to Nidhi rupees 14,000. 8th April, Nidhi paid 14,000 rupees cash. 10th April, purchased goods for 20,000 rupees on credit from Ritu. 14th April, insurance paid by check 6,000 rupees. 18th April, paid rent 2,000 rupees. 20th April, goods costing rupees 1,500 given as charity. 24th April, purchased office furniture for 11,200. 29th April, cash withdrawn for household purposes, rupees 5,000. 30th April, interest received cash 1,200. 30th April, cash sales 2,300. 30th April, commission paid 3,000 rupees by check. 30th April, telephone bill paid by check 2000 rupees. 30th April, paid salary in cash 12,000 rupees. Alright, we have gone through the question. Now let's start recording each transaction in the journal step by step. Our first transaction is 1st April, started business with cash rupees 1,50,000. Here the two accounts affected are cash account and capital account. Cash account is real account and cash comes in the business, so it is debited. And capital account is personal account and owner is the giver, so it is credit. Let's see how we'll record it. Journal entries in the books of Mr. Ram, date, particulars, ledger folio, debit, credit. 2025, 1st April, cash account debit 1,50,000 rupees. To capital account 1,50,000 rupees. And the narration is being business started with cash. Next. 1st April, purchased goods from Manisha 36,000 rupees. Here the two accounts affected are purchase account and Manisha's account. Why? Because we have purchased it on credit. It is not mentioned that we have paid. So it is assumed as credit transaction. So the two accounts are purchase account and Manisha's account. Purchase account, it is nominal account and purchase is an expense, so it is debit. And Manisha's account, Manisha is person, so it is personal account. And Manisha is the giver of goods, so it is credit. Let's see how we'll record it. 1st April, purchase account debit 36,000 rupees to Manisha's account 36,000 rupees, being goods purchased on credit. Next. 1st April, purchased stationery for cash 2,200 rupees. Here the two accounts affected are stationery account and cash account because we have paid the cash. So, stationery account is nominal account and we have paid for stationery. So, it is expenses. Debit all expenses. So, it is debit. And cash account is real account and cash goes out of the business. After purchasing stationery, cash goes out of the business. So, it is credit what goes out. Let's see how we'll record it. 1st April, stationery account debit 2,200 and to cash account 2,200 on credit side, and the narration is being purchased stationery for cash. Next. 2nd April, opened bank account with SBI, rupees 35,000. Here the two accounts affected are bank account and cash account. Why? Because bank is the receiver of cash and cash goes out of the business. So bank account is real account, and cash comes in the bank. So it is debit what comes in. And cash account is also real account, and cash goes out of the business. So it is credit. Let's see how we'll record it. 2nd April, bank account debit 35,000 rupees on debit side, to cash account on the credit side 35,000 rupees. And the narration is being opened bank account with SBI. Next. 2nd April, sold goods to Priya 16,000 rupees. Here the two accounts affected are Priya's account and sales account. Here it is not mentioned that we have received cash, so it is assumed as credit sales. The two accounts are Priya's account and sales account. Priya is person, so it is personal account, and Priya is the receiver of goods. We have sold her goods, she has received. So Priya is the receiver of goods, and debit the receiver, so it is debited. And sales account is nominal account. After sales, we will get the cash. We have not received it immediately, but in future we will receive it. So it is income. So credit all incomes. So it is credited. Let's see how we'll record it. 2nd April, Priya's account debit 16,000 rupees on the debit side, to sales account credit side 16,000 rupees, and the narration is being goods sold to Priya on credit. Next. 3rd April, received check from Priya 16,000 rupees. On 2nd April, we have sold goods to Priya, and on 3rd we have received check from Priya. So the two accounts are bank account and Priya's account. It is received by check, so bank account, and Priya is the giver, so it is bank account and Priya's account. So bank account is real account, and for bank cash comes in, so debit what comes in. And Priya's account is personal account because Priya is person and Priya is the giver, so it is credit. Let's see how we'll record it. 3rd April, bank account debit 16,000 rupees on the debit side, and to Priya's account 16,000 rupees on the credit side, and the narration is being check received from Priya. 5th April, sold goods to Nidhi 14,000 rupees. Here the two accounts affected are sales account and Nidhi's account. Nidhi is person, so it is personal account, and we have sold goods to Nidhi. So Nidhi is the receiver, so debit the receiver. And sales account is nominal account because sales is income, so it is credit. Let's see how we'll record it. 5th April, Nidhi's account debit 14,000 rupees, to sales account 14,000 rupees, and the narration is being sold goods to Nidhi on credit. Next. 8th April, received cash from Nidhi 14,000 rupees. On 5th April, we sold goods to Nidhi, and now we are receiving cash from Nidhi. Here the two accounts affected are cash account and Nidhi's account. Cash account is real account, and cash comes in the business, so it is debit. And Nidhi's account, Nidhi is person, so it is personal account. And Nidhi is the giver of cash, so it is credit. Let's see how we'll record it. 8th April, cash account debit 14,000 rupees on the debit side, to Nidhi's account 14,000 rupees on the credit side, and the narration is being cash received from Nidhi. Next. 10th April, purchased goods on credit from Ritu 20,000 rupees. Here the two accounts affected are purchase account and Ritu's account. Purchase account, it is nominal account, and purchase is expenses, so it is debit. Ritu's account, Ritu is person, so it is personal account, and Ritu is the giver, so it is credit. Let's see how we'll record it. 10th April, purchase account debit 20,000 rupees on the debit side, to Ritu's account 20,000 rupees on the credit side, and the narration is being purchased goods on credit. Next. 14th April, insurance premium paid by check 6,000 rupees. Here the two accounts affected are insurance premium account and bank account. Because we have paid by check, so bank account. Insurance premium account, it is nominal account because Insurance premium is expenses, so it is debited. And bank account is real account, and cash goes out of the bank, so it is credit. Let's see how we'll record it. 14th April, insurance premium account debit 6,000 rupees to bank account 6,000 rupees. And the narration is being paid insurance premium by check. Next, 18th April, paid rent 2,000 rupees. Here the two accounts affected are rent account and cash account. Rent account is nominal account and rent is expenses, so it is debit. And cash account is real account and cash goes out of the business, so it is credit. Let's see how we'll record it. 18th April, rent account debit 2,000 rupees on the debit side and to cash account 2,000 rupees on the credit side. And the narration is being paid rent. Next, 20th April, goods given as charity 1,500. You gave goods free of cost for charity. That means these goods are no longer available for sale, so your purchases are reduced. Here the two accounts affected are charity account and purchase account. Why purchase account? When you buy goods, you debit the purchase account because it is expenses. But when those goods are not sold but given away, it means part of that expense is not for business use anymore. So we reduce the purchase amount by crediting the purchase account. See, whenever goods go out but not sold, like charity, drawing, or samples, you credit purchase account because goods are decreasing. In short, purchase account decreases. Okay. Okay. Here, two accounts affected are charity account and purchase account. Charity account, it is nominal account because charity is an expense. So, debit all expenses. And purchase account is nominal account and it is an expense. So, it is credited. Let's see how we'll record it. 20th April, charity account debit 1,500 to purchase account 1,500. Narration, being goods given as charity. Next, 24th April, purchased office furniture for cash 11,200. Here the two accounts affected are furniture account and cash account. Furniture account is real account and furniture comes in the business, so it is debited. And cash account is also real account and cash goes out of the business, so it is credited. Let's see how we'll record it. 24th April, furniture account debit 11,200 to cash account 11,200. And the narration is being purchased office furniture. Next, 29th April, cash withdrawn for personal use, rupees 5,000. Here the two accounts affected are drawings account and cash account. Drawings account is personal account and owner is the receiver, so it is debit. And cash account is real account and cash goes out of the business, so it is credit. Here the owner has withdrawn cash. If it was goods withdrawn, then we would take it as purchases. Just because the owner has withdrawn cash, we are taking it as cash account. Let's see how we'll record it. 29th April, drawings account debit 5,000 rupees in the debit side and to cash account, credit side 5,000 rupees. And the narration is being withdrawn cash from the business for personal use of proprietor. Next, 30th April, interest received in cash 1,200. Here the two accounts affected are cash account and interest account. Cash account is real account and cash comes in the business because it is income. So cash comes in the business, so it is debit. And interest account is nominal account and interest we have received, so it is income, so it is credit. Let's see how we'll record it. 30th April, cash account debit 1,200 to interest income account 1,200. And the narration is being interest received. Next, 30th April, cash sales 2,300. Here the two accounts affected are cash account and sales account. Previously, we have seen the transactions of credit sales, but here it is mentioned that we have sold the goods and we have received cash. So, cash sales. If nothing was mentioned, we would take it as credit. So it is mentioned cash sales 2300. So the two accounts affected are cash account and sales account. Cash account is real account and cash comes in the business. So it is debited. And sales account is nominal account. And after sales, we will receive cash. So it is income. Sales is income. So sales is credited. Let's see how we'll record it. 30th April, cash account debit 2300 to sales account 2300 and the narration is being sold goods for cash. Next, 30th April, commission paid by check 3000 rupees. Here the two accounts affected are commission account and bank account because it is paid by check. So, commission account is nominal account and commission is an expense. So, debit all expenses and losses. And bank account is real account and cash goes out of the bank. So, credit what goes out. Let's see how we'll record it. 30th April, commission account debit 3000 rupees on the debit side to bank account 3000 rupees on the credit side. And the narration is being paid commission by check. 30th April, telephone bill paid by check 2000 rupees. Here the two accounts affected are telephone expenses account and bank account because it is paid by check. Telephone expenses, it is nominal account because it is expenses and debit all expenses and losses. And bank account is real account and cash goes out of the bank, so it is credited. Let's see how we'll record it. 30th April, telephone expense account debit 2000 rupees on the debit side to bank account 2000 rupees on the credit side. And the narration is being paid telephone bill by check. 30th April, paid salary in cash 12,000 rupees. Here the two accounts affected are salary account and cash account. Salary account is nominal account and paying salary is an expenses, so it is debit. And cash account is real account and cash goes out of the business, so it is credited. Let's see how we'll record it. 30th April, salary account debit 12,000 rupees on the debit side to cash account 12,000 rupees on the credit side. And the narration is being paid salary. Now we have recorded all the transactions. Let's calculate the total. So it is 3,49,400 on each side. As you can see, the total of debit side and the credit side is the same, 3,49,400 each. That's how we know our journal entries are correctly recorded. In every journal, total debits must always be equal to total credits because for every debit there is an equal credit. If both sides match, it means all transactions are balanced correctly and recorded without mathematical errors. If your debit and credit totals don't match, that means there is a mistake in one of the entries. Maybe the amount, account, or posting is wrong. Always double check when the totals don't agree. That completes journal entries for Mr. Ram's transaction for April 2025. Notice every transaction follows the same logic. Identify the accounts, classify them, and then apply the debit and credit rule. If you found this video helpful, do like, share, and subscribe to Accountant's Desk for more accounting tutorials. And comment below which topic do you want to learn in the next video. And if you are a small business owner in need of bookkeeping services, just fill out the Google form linked in the description and we will reach out to you. Thank you for watching. If journal entries are weak, accounting will always feel confusing. In this video, we will solve journal entry problems step by step. I will not only tell you the entry, but also explain why each account is debited and credited so that you can identify the entry quickly. Let's start from the first and most important rule. Golden rules of accounting. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. Before solving any problem, I always remember myself of the golden rules. Don't memorize entries. Identify the account type first. Once account type is clear, entry becomes automatic. started business with cash 1 lakh rupees. Here the two accounts affected are cash account and capital account. Cash account, cash account is real account. Why? Because cash comes in the business. So it is debited. And capital account. Capital account is personal account. And owner is the giver of the capital. So it is credited. So the journal entries are cash account debit 1 lakh rupees to capital account 1 lakh rupees. And the narration is being capital introduced in cash. Cash is coming into the business. So it is a real account. So it is debited. And capital represents the owner. So it is a personal account. So it is credited. Remember, owner is separate from the business. Next, purchased goods for cash 20,000 rupees. Here the two accounts affected are purchase account and cash account. Purchase account. Purchase account is nominal account. Why? Because it is expense. And the rule for nominal account is debit all expenses. And the other account is cash account. Cash account is real account. And cash goes out of the business. After purchasing the goods, we pay the cash. So cash goes out of the business. And the rule for real account is credit what goes out. So it is credited. And the journal entry is purchase account debit 20,000 rupees to cash account 20,000 rupees. And the narration is being purchased goods for cash. Goods are purchased for resale. That is an expense. So debit expenses. And cash. Cash goes out. So we credit the cash. Next, purchased goods on credit from Ramesh 15,000 rupees. Here the two accounts affected are purchase account and Ramesh account. Why? Because we purchased on credit. So purchase account. Purchase account is nominal account. Why? Because it is expenses. And the rule for nominal account is debit all expenses. And Ramesh account. Ramesh is person, so it is personal account. And Ramesh is the giver of goods, so he is the giver. And the rule for personal account is credit the giver. So it is credited. And the journal entry is purchase account debit 15,000 rupees to Ramesh account 15,000 rupees. And the narration is being purchased goods from Ramesh on credit. When goods are purchased on credit, supplier becomes giver. So Ramesh is credited. This entry creates a liability. Next, sold goods for cash 18,000 rupees. Here the two accounts affected are cash account and sales account. Cash account. Cash account is real account. Why? Because cash comes in the business. When we sell the goods, we receive the cash. So cash comes in. And the rule for real account is debit what comes in. And sales account. Sales account is nominal account. And sales is income. So the rule for nominal account is credit the incomes. So it is credited. And the journal entry is cash account debit 18,000 rupees to sales account 18,000 rupees. And the narration is being sold goods for cash. Next, sold goods on credit to Suresh 12,000 rupees. Here the two accounts affected are Suresh account and sales account. Suresh account. Suresh is person, so it is personal account. And Suresh is the receiver of goods. We sold the goods and Suresh received the goods. So Suresh is receiver. And the rule for personal account is debit the receiver. So it is debited. And sales account. Sales account is nominal account and sales is income. After selling the goods, we receive money. So sales is income. So it is credit. Here we sold the goods on credit. Suresh has not paid us immediately, but he will pay us. So the journal entry is Suresh account debit 12,000 rupees to sales account 12,000 rupees. And the narration is being sold goods to Suresh on credit. Suresh is our customer and he received the goods. So he is debited. This creates debtors in balance sheet. And if Suresh had paid us immediately, instead of Suresh, we would take cash account. Okay. Next, paid rent 5,000 rupees. Here the two accounts affected are rent account and cash account. Rent account. Rent account is nominal account. Why? Because rent is expenses. And the rule for nominal account is debit all expenses. And cash account. Cash account is real account. And cash goes out of the business. We paid the rent and cash goes out. So the rule for real account is credit what goes out. So it is credited. And the journal entry is rent account debit 5,000 rupees to cash account 5,000 rupees. And the narration is being paid rent. Rent is expense, so we debited rent. Students often confuse rent with asset, but rent is never an asset, it is an expense. Next, received commission 3,000 rupees. Here the two accounts affected are cash account and commission account. Cash account. Cash account is real account. Why? Because cash comes in the business. We are receiving commission, so cash comes in the business. And the rule for real account is debit what comes in. So it is debited. And commission account. Commission is nominal account. Why? Because commission is income and the rule for nominal account is credit all incomes. So it is credited. And the journal entry is cash account debit 3,000 rupees to commission account 3,000 rupees. And the narration is being received commission. Income is always credited. This will appear in profit and loss account later on. Next, purchased furniture for cash 25,000 rupees. Here the two accounts affected are furniture account and cash account. Furniture account. Furniture account is real account. Why? Because furniture comes in the business. So the rule for real account is debit what comes in. So furniture is debited. And cash account. Cash account is real account. Why? Because cash goes out of the business. We purchase the furniture and we paid the cash. So cash goes out of the business now. So the rule for real account is credit what goes out. So cash is credited. And the journal entry is furniture account debit 25,000 rupees to cash account 25,000 rupees. And the narration is being purchased furniture. Furniture is an asset, not an expense. Okay. Next, paid wages 4,000 rupees. Here the two accounts affected are wages account and cash account. Wages account. Wages account is nominal account. Why? Because wages is expenses. And the rule for nominal account is debit all expenses. So it is debited. And cash account is real account. And cash goes out of the business. We pay the wages and cash goes out of the business. So it is credited. And the journal entry is wages account debit 4,000 rupees to cash account 4,000 rupees. And the narration is being paid wages. Next, cash deposited into bank 10,000 rupees. Here the two accounts affected are bank account and cash account. Bank account, it is personal account and bank is the receiver. We deposit the money into bank and bank receives the money. So bank is receiver. And the rule for personal account is debit the receiver. Bank has received the money, so bank is debited. And cash account. Cash account is real account and cash goes out of the business. So we deposit the money into bank. It goes out from the business and bank receives the cash. So cash goes out of the business. So the rule for real account is credit what goes out. So cash is credited. And the journal entry is bank account debit 10,000 rupees to cash account 10,000 rupees. And the narration is being deposited cash into bank. This is not an income. Money is moving from one form to another. Cash decreases and bank increases. If you understood these 10 entries clearly, journal entries will never scare you. In the next video, I will solve more journal problems like part payment, discount, outstanding, prepayment, and more. If you liked the video, don't forget to like, share it with your friends, and subscribe to Accountant's Desk for more accounting concepts explained in simple way. And if you are a small business owner in need of reliable bookkeeping services, just fill out the Google form linked in the description and we will reach out to you. Thank you for watching. In the previous video, we solved basic journal entries. Today, we will move one level higher, exam level journal entry problems. Remember, before passing entry, identify the account type, apply golden rules. Think if it is expense, income, asset, or liability. So, let's get started. Paid RAM 9,800 in full settlement of 10,000 rupees. Here the two accounts affected are RAM account and cash account. RAM account. RAM account is personal account. And RAM is the receiver, so it is debit. And cash account is real account and cash goes out of the business, so it is credit. And discount received is income, so the rule for nominal account is credit all incomes. The journal entry is RAM account debit 10,000 rupees to cash account 9,800 rupees to discount received account, that is 200. And the narration is being discount received on full settlement of account. Here payment is made in full settlement, so we close the personal account for the full amount, that is 10,000 rupees, because Ram's account balance becomes 0. Now we need not pay anything to Ram, so we have taken 10,000 rupees. And discount received is income, not expense, because the business gained. We have received 200 rupees discount, so we will pay less 200 rupees. Next, goods worth rupees 2,000 withdrawn by owner for personal use. Here the two accounts affected are drawings account and
Purchase account, drawings account. Drawings account is personal account and owner is the receiver, so it is debited. And purchase account. Purchase account is nominal account and purchase is expense. So the rule for nominal account is credit all expenses. And the journal entry is drawings account debit 2000 rupees to purchase account 2000 rupees. And the narration is being goods withdrawn by proprietor. This is not a sale. No outsider is involved. Goods taken by owner means business expense reduces and drawings increases. Never credit sales here. Next. Outstanding rent 3000 rupees. Here the two accounts affected are rent account and outstanding rent account. Rent account is nominal account. Why? Because rent is expenses and the rule for nominal account is debit all expenses. And outstanding rent account, it is personal account and it is giver, so the rule for personal account is credit the giver. See, rent is an expense, so it is nominal account. Outstanding rent means expense is already incurred but not yet paid. So business owes money to someone, that is landlord. So it creates liability, not an expense. And nominal accounts are expenses or incomes of the current period. And outstanding rent, it is not an expense itself. It is an amount payable. So it is personal account. Personal account includes persons or entities to whom the business owes money. Even if the landlord's name is not given, outstanding rent represents a person to be paid. So we treat it as personal account. Remember, all outstanding expenses are liabilities and liabilities are personal accounts. So the journal entry is rent account debit 3000 rupees to outstanding rent account 3000 rupees. And the narration is being outstanding rent. Next. Prepaid insurance 1200. Here the two accounts affected are prepaid insurance account and insurance account. Prepaid insurance account, it is real account and it is asset, so it is debited. And insurance account is nominal account and it is expense, so it is credited. And the journal entry is prepaid insurance account debit 1200 to insurance account 1200. And the narration is being prepaid insurance. Prepaid means payment is made but benefit belongs to the next period, so we remove that part from expense and treat it as an asset. Think in terms of benefit, not cash. Next. Commission accrued 2500. Here the two accounts affected are accrued income account and personal account. Accrued income account, it is personal account and it is receivable, so it is debited. And commission account is nominal account and commission is income, so it is credit. So the journal entry is accrued income account debit 2500 to commission account 2500. And the narration is being income accrued. Accrued income means income is earned but not yet received. Business has a right to receive it, so it becomes an asset. Income must be recorded in the same year in which it is earned. Next. Provide depreciation on machinery 5000 rupees. Here the two accounts affected are depreciation account and machinery account. Depreciation account is nominal account and it is expenses, so it is debited. And machinery account is real account and it is an asset, so we credit it. So the journal entry is depreciation account debit 5000 rupees to machinery account 5000 rupees. And the narration is being depreciation charged. Depreciation is not about cash outflow, it is about loss in the value of an asset. That's why depreciation is an expense and asset value is reduced. If you watch the previous video on depreciation, then you will understand it better. Next, bad debts written off 1000 rupees. Here the two accounts affected are bad debts account and debtors account. Bad debts account is nominal account and bad debts is loss, so it is debit. And debtors account is personal account and debtor is the receiver, so it is credit. The journal entry is bad debts account debit 1000 rupees to debtors account 1000 rupees. And the narration is being bad debts written off. Bad debts are the amount of money a business cannot recover from its customer because the customer will not pay the money owed. It is treated as loss for the business and debtors account is closed. Bad debts account is written off, not transferred. Next, commission received in advance 2000 rupees. Here the two accounts affected are commission account and commission received in advance. Commission account is nominal account. Why? Because it is income, so it is debit. And commission received in advance account, it is personal account. And it is giver, so it is credited. Why? Because it is unearned income. Commission received in advance is unearned income because commission received in advance represents money received for services but not yet provided. Receiving the money creates an obligation to perform the work. Hence, the credit shows you owe future services and the money is not yet earned. So the journal entry is commission account debit 2000 rupees to commission received in advance 2000 rupees. And the narration is being income received in advance. This income does not belong to this year. Even though cash is received, it creates a liability because service is still due. Always remember, cash receipt does not always mean income. Next, interest on capital 4000 rupees. Here the two accounts affected are interest on capital account and capital account. Interest on capital, it is nominal account and it is expenses, so it is debited. And capital account is personal account and it is giver, so it is credited. And the journal entry is interest on capital account debit 4000 rupees to capital account 4000 rupees. And the narration is being interest on capital allowed. Interest on capital is an expense for the business but income for the owner, so the business records it as an expense and increases the capital. This adjustment is done to show the true profit. Next, interest on drawings 1500. Here the two accounts affected are drawings account and interest on drawings account. Drawings account is personal account and drawings it is receiver, so it is debited. And interest on drawings account, it is nominal account and it is income, so it is credited. And the journal entry is drawings account debit 1500 to interest on drawings account 1500. And the narration is being interest on drawings charged. When owner withdraws money and interest is charged, it becomes income for the business. So drawings increases and income is recorded. If you identify expense, income, asset or liability correctly, you will never go wrong. If you can solve these entries confidently, journal entries are no longer a problem. If you found this video helpful, don't forget to like this video, share it with your friends, and subscribe to Accountant's Desk for more accounting lessons. And if you are a small business owner in need of reliable bookkeeping services, just fill out the Google form linked in the description and we will reach out to you. Thank you for watching. In this video, we will solve journal entry problems which are commonly asked in exams. These problems are slightly higher than part 1 and part 2. So, if you haven't watched them, please watch them first. Let's get started. Paid rent 2000 rupees and insurance 1000 rupees in cash. Here, the accounts affected are rent account, insurance account, and cash account. Rent account. Rent account is nominal account. Why? Because it is expenses. So it is debited. And insurance account. Insurance account is nominal account. Why? Because it is expense. So it is debited. And cash. Cash is real account. And cash goes out of the business. So it is credited. So the journal entry is rent account debit 2000 rupees. Insurance account debit 1000 rupees to cash account 3000 rupees. And the duration is being rent and insurance paid in cash. In this problem, two expenses are paid. So, rent and insurance are expenses of the business. So, expenses fall under nominal account, and nominal account rule says debit all expenses. And cash is real account, and cash goes out of the business. So, according to the real account rule, we credit cash. Next, purchased furniture for 10,000 rupees and paid installation charges 1,000 rupees in cash. Here, the accounts affected are furniture account and cash account. Furniture account. Furniture account is real account and furniture comes in the business. So it is debited. And cash account. Cash account is real account and cash goes out of the business. So it is credited. And the journal entry is furniture account debit 11,000 rupees to cash account 11,000 rupees. And the narration is being furniture purchased and installation charges paid in cash. Furniture is fixed asset, so it is a real account. And installation charges are necessary to bring the asset into use, so they are added to asset value. And cash is paid, so cash goes out of the business. Next, paid salaries 5,000 rupees. 1000 rupees is outstanding. Here, the accounts affected are salary account, cash account, and outstanding salaries account. Salary account is nominal account because it is expenses, so it is debited, and cash account is real account, and cash goes out of the business, so it is credited. And outstanding salary, it is personal account, and the business is the giver, so it is credit. So the journal entry is salary account debit 6,000 rupees to cash account 5,000 rupees to outstanding salaries account 1,000 rupees. And the narration is being salaries paid and outstanding salary. Salaries are an expense, so debit salaries. Cash is credited. Next, received commission 3,000 rupees in cash, out of which 500 is unearned. Commission received is income, but unearned commission is a liability. So the accounts affected are cash account, commission account, unearned commission account. Cash account is real account and cash comes in the business, so it is credit. And commission account is nominal account and commission is income, so it is credit. Unearned commission, it is personal account and it is received in advance, so it is giver, so it is credited. And the journal entry is cash account debit 3,000 rupees to commission account 2,500 to unearned commission 500 rupees. And the duration is being commission received, part unearned. Here cash is received, so cash comes in, and commission earned is income, so it is credited. And unearned commission is income received in advance, so it is treated as liability. So personal account. Next, paid electricity bill 2,400 for business and 600 for owner's house. Business expense is debited, so the accounts affected are electricity expenses, drawings account, and cash account. Electricity expense account, it is nominal account. Electricity is an expense, so it is debited. And drawings account is personal account. And drawings owner is the receiver, so it is debited. And cash account is real account, and cash goes out of the business, so it is credited. So the journal entry is electricity expense account debit 2400, drawings account debit 600, to cash account 3000 rupees. And the narration is being electricity bill paid, partly business and partly personal. Business electricity is an expense, and owner's personal electricity expense is drawing, not business expenses. And cash is paid, so it is credited. Next, goods worth 2000 rupees withdrawn by owner for personal use. This is drawings, not an expense. Here the accounts affected are drawings account, purchase account. Drawings account is personal account and owner is the receiver, so it is debited. Purchase account is nominal account and purchase reduces the expense, so it is credited. When owner withdraws goods, it is drawings and purchases are reduced, so purchase account is credited. Here the journal entry is drawings account debit 2000 rupees to purchase account 2000 rupees, and the narration is being goods withdrawn by owner for personal use. Next, purchased goods from Ram 8000 rupees and returned goods worth 1000 rupees. Here the two accounts affected are purchase account and Ram account. Purchase account is nominal account and purchase is expenses, so it is debited. And Ram account is personal account and Ram is the giver of goods, so it is credited. And the journal entry is purchase account debit 8000 rupees to Ram account 8000 rupees, and the narration is being goods purchased from Ram on credit. Purchases are expenses, so debit purchases. And Ram supplied goods, so he is giver, hence it is credited. And the next part is return goods worth rupees 1000. Here the two accounts affected are Ram account and purchase return account. Ram account is personal account and Ram is the receiver of the goods, because we have purchased the goods and now we are returning it to Ram. So he is the receiver of goods, so it is debited. And purchase return. Purchase return is nominal account and purchase return is income, because when we purchase the goods, we pay the money. When we return the goods, we take back the money and we give the goods. So it is income. So it is credited. And the journal entry is Ram account debit 1000 rupees to purchase return account 1000 rupees. And the narration is being goods purchased from Ram and part returned. Ram receives the goods back, so debit Ram, and purchase return reduces expenses, so it is treated as income. Next, paid rent in advance 1200. Here the two accounts affected are prepaid rent account and cash account. Prepaid rent account, it is personal account and it is receiver, so it is debited. And cash account is real account and cash goes out of the business, so it is credited. Rent paid in advance is not an expense yet. It is a benefit receivable in future, so treated as an asset. So the journal entry is prepaid rent account debit 1200 to cash account 1200, and the narration is being rent paid in advance. Next, interest on capital 2000 rupees is due but not paid. The other two accounts affected are interest on capital account and capital account. Interest on capital account, it is nominal account because it is expenses. We need to pay the interest to the owner, so it is expense and it is debited. And capital account is personal account and it is giver, so it is credited. And the journal entry is interest on capital account debit 2000 rupees to capital account 2000 rupees, and the narration is being interest on capital provided. Interest on capital means the business is paying interest to the owner for using his money. From the business point of view, interest on capital is an expense because it reduces business profit. Capital belongs to the owner and the owner is a person, so capital account is treated as personal account. Interest is due but not yet paid, so the owner is the giver of benefit to the business. So, debit interest on capital and credit capital account. Even if interest is not paid, we must record it because accounting follows the accrual concept, not cash basis. Next, depreciation charged on machinery, 3000 rupees. Here the two accounts affected are depreciation account and machinery account. Depreciation account is nominal account and it is expenses, so it is debited. And machinery account is real account and the asset value is reduced, so it is credited. And the journal entry is depreciation account debit 3000 rupees to machinery account 3000 rupees. And the narration is being depreciation charged on machinery. Depreciation is an expense and it reduces asset value. So depreciation is debited and machinery is credited. So that's it for this video. If you found this video helpful, don't forget to like this video, share it with your friends, and subscribe to Accountant's Desk for more accounting lessons. And if you are a small business owner in need of reliable bookkeeping services, just fill out the Google form linked in the description and we will reach out to you. Thank you for watching.